Good afternoon and welcome everyone to the Center for American Progress. We're delighted that you've joined us today, both here and online, for this event on accessing public capital without public disclosure. My name is Emily G, and I'm the Senior Vice President for CAP's Inclusive Growth Department. A major focus of CAP's work on financial regulation policy has been on emerging risks, such as climate change and workforce issues. We have spoken out strongly on the need for companies to make robust climate-related risk disclosures, including about the greenhouse gas emissions they're responsible for, disclosures about diversity, pay, and treatment of their workers, and the diversity of companies' boards, and much more. But there's one big problem. A rapidly growing number of companies aren't required to adhere to most disclosure rules, not even rules requiring the most basic disclosures about their operations, financials, management, and business prospects, much less about the climate and other risks they face. These companies take advantage of exceptions to public registration and disclosure rules. And these exemptions have proliferated in recent decades and have enabled hundreds of multi-billion-dollar companies to raise capital from a broad swath of American public without being required to make the disclosures that public companies make to their investors and to the public. In fact, more capital is now raised in private market transactions than in public markets. The lack of required disclosures in private market transactions poses serious risks, for example, to the security of workers' retirement savings, to the quality of healthcare and rental housing in local economies, and the stability of the financial system and the economy as a whole. Simply put, this rapidly growing problem affects us all. Fortunately, we have today an impressive lineup of experts here to discuss what's happening. We are deeply honored to welcome Commissioner Carolyn Krenshaw, who's at the U.S. Securities and Exchange Commission, to deliver keynote remarks. Commissioner Krenshaw served in positions across the SEC prior to her current appointment. Previously, as an attorney in private practice, she represented public companies, broker-dealers, and investment advisors on complex security law investigations and enforcement matters. Commissioner Krenshaw brings unparalleled wisdom and depth of understanding on today's topics, as well as an unwavering commitment to bringing light when private markets are cloaked in darkness. Following Commissioner Crenshaw's remarks, my colleague Alexandra Thornton, CAP's Senior Director for Financial Regulation, will lead a conversation with two distinguished securities law experts on the many ways that private markets put us all at risk. Renee Jones is a professor and Dr. Thomas F. Carney Distinguished Scholar at the Boston College Law School. She recently served as the Director of the Division of Corporation Finance at the SEC. And George Georgiev is Associate Professor at Emory University School of Law. He has studied and gathered important data points on this growing problem. And now I'd like to invite up Commissioner Krenshaw. Please join me in giving her a warm welcome.
All right. Good afternoon. I think we're in afternoon now. How's everyone doing today? It's good to be here. And thank you, Emily, for that kind introduction and for hosting the event today. I am grateful to be at the Center for American Progress, and I'm grateful for you for organizing the event, as well as for the invitation to speak today. The topic of private markets is timely. Private markets are an increasingly large portion of the overall markets. That means solutions to any of the most important issues in today's markets will naturally require consideration of the private markets and the assets that trade in them. Before I begin, I do have to give the standard disclaimer that I speak today in my official capacity as a commissioner of the Securities and Exchange Commission, but the speech does not necessarily reflect the views of the commission, the other commissioners, or members of the staff. I remember my first few days in private practice. Before joining my firm, I had intended to practice criminal law, not securities law. The learning curve at first was steep. Though I had learned about materiality and the basics of public offering process, there's a lot you don't learn in law school. No offense to the law professors here. The acronyms alone can take you years to master. And after meetings, I've sometimes found myself searching through rule text, academic articles, and the internet to glean context and background on questions or ideas that we had discussed. Things obviously got more familiar with every new experience. And the more I practiced, the more my research delved into complex and nuanced questions. But I have found that even as my knowledge base has grown, there always will be questions I don't know the answers to, areas I don't know as well as others, and issues I find confusing. Sometimes this is because the words themselves seem to bear little resemblance to what they're actually describing. So, for example, I spent much of my time in private practice litigating issues that had arisen in securities offerings, with plaintiffs alleging misconduct by one of the participants in the offering. Even when these were termed private offerings, I found that they were often sold to hundreds of different investors, often with little financial experience, and none of whom had any relationship with the company in which they were investing. I confess this still does not make a lot of sense to me, and I've recently spoken about this topic, and you're going to delve deeply into it today. Likewise, I thought I knew what a bank was. But in the aftermath of the global financial crisis, we also began to hear more and more about shadow banks. These non-bank entities engaged in many activities associated with the traditional banking system, and thus posed similar spillover risks as depository banks. Shadow banks function by intermediating between borrowers and investors in capital markets. But they had structured themselves in ways that allowed them to evade many of the regulations designed to prevent banks from posing undue risks to the financial system. The resultant lack of oversight was a principal cause of the crisis. As with private offerings, I've also spoken about this topic recently. And I believe that as industries become larger, it's important that we reevaluate the regulatory framework to ensure it remains fit for its purpose. And allowing parts of the financial system to operate in the shadows creates risks to investors and the financial system as a whole. And this brings me to today. I am increasingly concerned with loans that look less and less like loans. The syndicated loan market has grown vastly larger in recent years, and the loans themselves are far different from traditional loans. Many are sold to hundreds of passive investors. They trade frequently on standardized documentation, and they're used to conduct activities far beyond traditional borrowing to buy a piece of machinery or a new building. Despite this significant growth, much of this market is not subject to meaningful regulation, and investors are being put at risk. In addition, I'm concerned that systemic financial issues are lurking in the market. And if these instruments are not monitored more closely, the risk to the financial system itself will continue to grow. Exactly where this story begins is hard to pin down. We're all familiar with the idea of lending memorialized in It's a Wonderful Life. The film is certainly an easy place to think of as a starting point. Customers obtained loans from a particular bank, and those loans were made using the deposits at the bank. But as the economy grew and capital needs increased, the business of lending began to shift. Banks kept lending, but more often shared the risk of large transactions with other banks as part of a syndicate. This allowed banks to maintain relationships with their customer rather than losing that customer to the bond market, but not to take on the entire credit risk on their own. Over time, the link back to It's a Wonderful Life has grown more attenuated. Banks or groups of banks originate loans, but quickly syndicate nearly all of the risk to others, either as a participation, meaning the other party's relationship is only with the bank and not to the underlying borrower, or an assignment, meaning the assignee has direct contractual privity with the borrower. Syndications, loan participations, and assignments are not new. But whereas in previous decades, they were small in scale and bespoke, with banks selling interest to a small circle of of highly sophisticated institutional investors, often other banks. These practices are now supersized and systematized. We are a far cry from banks negotiating participations or assignments of one large loan directly and with only a handful of peers. Instead, investment banks and other financial institutions have become dominant players. These global institutions source loans from other banks and, increasingly, shadow banks, and market them to a range of investors. Frequently, those investors are institutions like registered investment funds, pension funds, insurance companies, collateralized loan obligations or CLOs, or other financial institutions that have large sums of money to deploy, but do not have the customer relationships to make loans directly. Helpfully, for these counterparties, they are not subject to bank capital regulations. One commentator called this a symbiotic arbitrage. With banks arranging loans they're not able to hold on their own books, but instead sell to institutional purchasers. Some of these changes are due to regulatory developments. For instance, discussions of this trend frequently note that the Basel framework's risk-based capital rules pushed banks to diversify their portfolios to make them safer. That this, in turn, led to banks holding less of any particular loan on their own books. The impacts of the Basel framework and its successors have undoubtedly been positive overall and have contributed to a safer, more resilient banking system. But the downsides of the originate to distribute model, the same model that came to grief with respect to mortgages and triggered the global financial crisis in 2007 and 2008, have become more apparent over time. As the industry approach to loan syndication continued to develop, so too did misconduct in these largely unregulated corners of the market. As I mentioned a moment ago, the market and practices of loan syndication began to change dramatically. Driven in part by pressures to compete against investment banks that were able to place short-term commercial paper, banks began to market loan participations to their institutional clients. These new structures did not create any relationship with the borrower through which an investor could enforce its claim. They also did not provide a mechanism for investors to conduct their own diligence or information gathering. Instead, investors were entirely dependent on the efforts of the intermediary bank, which frequently retained little or no risk. The practical result of this structure was to leave investors with no recourse against any party in the transaction, even in the case of intentional misconduct. The results were sadly all too predictable. Certain companies were not able to make good on their debts and defaulted, leaving investors holding the bag with little to no recourse. For example, in a case in the late 1980s, a California bank marketed participations in loans it had made to a large company called Integrated Resources. The bank's marketing efforts involved conduct reminiscent of boiler room scams. This included daily cold calls to market the notes to investors who had neither the means nor the ability to conduct diligence on the company. These participations were marketed as investments, and they looked like securities. Investors relying on publicly available information purchased them as yield-enhancing alternatives to money market investments. There was no other risk-reducing regulatory framework, as the investors were not in privity with the underlying borrower, and thus had no ability to sue it directly. But in Banco Español v. Securities Pacific National Bank, the Second Circuit ruled that the investments in loan participations were not, in fact, securities, and dismissed the investors' claims. The Banco Español opinion applied the four-part test in Reeves v. Ernst & Young, which starts with the presumption that an instrument described as a note is a security, but then applies four factors to determine whether the note bears family resemblance to another instrument which is not a security, and if so, treats the instrument similarly. Even in 1992, when the Banco Español opinion came down, it was clear that the opinion, which has been variously described by some critics as puzzling, relatively cursory, and incorrect, was meant to be narrow. The Second Circuit retreated from its position almost immediately, at least in part. For example, when it denied a petition for rehearing, the court narrowed the scope of its original decision to emphasize that it only ruled with respect to the particular loan participations before it. And it also emphasized that, quote, even if an underlying instrument is not a security, the manner in which participations in that instrument are used, pooled, or marketed might establish that such participations are securities. Then, only 2 years later, a different panel of the same circuit court held that participations in mortgage loans were securities, which required the panel to consider a very similar factual situation and come out the opposite way. But despite the fact that the Banco Español opinion was controversial and narrow from the start and was undermined by a different ruling almost immediately, it continues to reverberate. A vibrant market of broadly syndicated loans, or BSLs, now exists. In some ways, a BSL looks like a loan to a company. Like a loan, companies can use the proceeds for any purpose, including purchasing equipment or issuing a dividend to their equity owners. In other ways, BSLs look more like bonds. Evidence of the obligation is generally in the form of a note purchased by institutional investors, not banks, such as investment funds, insurance companies, pension funds, CLOs, and various other non-bank financial institutions. In addition, like a bond, a company will generally only make interest payments, with a single principal payment due all at once upon maturity. BSLs are frequently structured to accommodate the market into which they are sold, and are designed to be relatively freely tradable among the institutions that invest in them. In the years since the Banco Español decision, the market for BSLs has continued to grow and evolve, including in ways that further undermine investor protections. Indeed, one cause of this undermining of investor protections may be the perception that federal securities laws do not apply. Recently, the SEC was asked to weigh in on whether a particular BSL met the definition of a security. The SEC did not weigh in, and the court ruled without such input. While that case has now been decided, it brought new attention to an issue that had been steadily growing. But will this be the end? The default assumption under Reeves is that a particular instrument marketed as a note is a security. And I'm concerned that the lack of clear guidance on which factors are sufficient for a BSL to rebut that presumption is resulting in market confusion. This could result in a court or the SEC being asked to weigh in again. This matters for both investors and the markets more broadly. Here's why. First, investor protection. I am aware that some commentators have argued that BSL investors do not need the protections of the securities laws because they're sophisticated institutions. Of course, institutional investors all need and deserve the protections of the federal securities laws. Consider the experience of institutional investors who purchased investments based on residential real estate before and during the global financial crisis of 2007 and 2008. And to be clear, it's not just institutional investors. Retail investors have enormous exposure to this market. For example, many of the vehicles that purchase BSLs are registered investment companies that focus on these types of assets. And these funds represent an important component of the market for BSLs. These funds, in turn, are owned by retail investors. Even if it's the case that the parties making investment decisions understand the important protections they're giving up, do the underlying investors? Funds investing in BSLs have been heavily marketed to retail investors in recent years as a hedge against rising interest rates. Less prominent, however, have been discussions of the differences in legal status between BSLs and other credit instruments like bonds. I believe it's unlikely that most retail investors in these funds would understand these nuances, and that they would reasonably expect their funds to have more legal protections than in fact exist. At a minimum, investors benefit from the protections of the crucial anti-fraud rules of the federal securities laws, such as Rule 10b-5. This rule polices any materially false or misleading statements made to investors. Rule 10b-5 and other rules do more. Consider, do investors in BSLs have sufficient protection from the risks of insider trading? Investors in traditional securities benefit from the knowledge that the SEC has the power to police when insiders trade on the basis of material non-public information. The enhanced investor protection results in increased market efficiency because investors do not need to worry that the other side is trading on the basis of inside information. When a BSL issue encounters difficulty, it's common for some of the notes it's issued to be purchased by investors specializing in distressed assets. That is, assets where the issuer may go bankrupt and where a savvy investor can make a profit by understanding which part of the issuer's capital structure are the most likely to recover. These investors also seek to profit by influencing the process by which the issuer seeks new capital to avoid bankruptcy. In many cases, these distressed investors negotiate for access to non-public information about the issuer, which is not available to all holders of its notes. To the degree the underlying assets are not securities, investors may decide to trade on the basis of this inside information without disclosing it to the market. The future of a market rife with insider trading is concerning at best, especially for investors in funds that have not received the inside information, which generally includes the passive vehicles favored by retail investors. Investors will get hurt. In addition, investors in securities rely on the vigilance of other participants in the process to ensure that an issuer discloses material information about its condition. In registered offerings, these are known as gatekeepers, and they exert a heavy influence in favor of investors. Of course, gatekeepers themselves can make mistakes, and we have seen lapses in the gatekeeper role lead to catastrophic results that affect the entire market. As a whole, though, their influence helps promote confidence in the market by providing a second set of eyes on issuers' disclosures before they reach investors. Even in unregistered offerings, where there's less of a role for formal gatekeepers, the banks, the accountants, and other service providers who participate in these offerings are motivated by the securities laws to ensure that documents they produce are accurate and not misleading. But when the assets themselves are not registered and are not even securities, do these participants exercise sufficient vigilance? In certain cases, we have seen that the answer is no, and that when the participants are not subject to the securities laws, they are more willing not to disclose, and even some cases to affirmatively hide, negative information about the company. They seem to rely on a caveat emptor doctrine that the securities laws were specifically designed to root out. Instead of a strong gatekeeper, documents marketing BSLs to investors frequently contain what are known in the industry as big boy representations. That acknowledgement is designed to protect the bank intermediating the transaction from liability by requiring investors to represent that they have done their own due diligence on the issuer of the notes. But frequently, investors have neither the means nor the time to conduct meaningful diligence. The loan is generally marketed to investors very late in the process, after nearly all the terms are settled, and generally an investor's only real choice is whether or not to participate. While some might argue that this is evidence of investors exhibiting rational ignorance, meaning the market's working, I think it could be also evidence of a market failure. The vehicles purchasing BSLs are doing so with other people's money, and the bonuses of the people investing on behalf of those vehicles will be paid long before it's clear whether the BSLs at issue will perform in line with expectations. This is a clear conflict. Shouldn't the expectations of the party who will actually be harmed be given precedence? In many contexts, parties are not allowed to waive rights that are central to a particular regulatory scheme. In fact, recognizing the fundamental unfairness and power imbalances that can exist when powerful parties are able to manipulate the circumstances of a transaction, Provisions in each of the major securities laws state that attempts to waive the protections of those laws are void. In light of the remedial nature of securities laws and the identity of many of the underlying investors, should we take a fresh look at assets that seem structured to avoid these important protections? I'm also concerned that risk has accumulated in the BSL market, and it may be reaching a scale that could affect the financial system more broadly. These assets trade privately, preventing securities regulators like the SEC from fully assessing whether particular institutions have too much exposure or whether other risks are brewing. Ultimately, the lack of these data could result in us being unable to detect risks that could affect the efficiency, fairness, or orderliness of our capital markets. And if a negative outcome does ultimately occur, the same lack of data could also hamper our ability to effectively respond. Worse, the types of BSLs that look most similar to securities also seem to have characteristics that make them especially likely to have pro-cyclical systemic effects on the market. Though BSLs trade regularly, many passive investors will only buy assets that trade on par docs. This essentially means that they're not trading at a discount due to distress or potential distress at the borrower. In fact, many investors have strict guidelines that require them to sell BSLs when they are downgraded below a certain level, well before the issuer is truly in distress. I'm concerned that this can result in a pro-cyclical cycle of sales, which in turn could cause forced sales of other BSLs market-wide and affect the ability of companies to receive financing, even though they are not otherwise distressed. The echoes of the 2008 financial crisis are hard to ignore. In addition, as BSLs grow larger, they naturally need to be syndicated by more participants. But this also renders them especially vulnerable if problems develop. If investors sour on the market, for example, due to forced sales by market participants depressing prices throughout the market, the largest loans that depend on being especially widely syndicated are the ones most likely to get hung on a bank balance sheet and potentially affect the financing of other companies. As we continue to move into a new era of higher interest rates, these effects may become more apparent. For example, many companies took advantage of the near zero interest rates of the pandemic and its immediate aftermath to borrow new money using BSLs. The amount of BSLs maturing in the next several years is more than any other comparable period in history. Though it's still in early innings, we're already seeing indications of what could happen when companies crash into this maturity wall. In the aftermath of the financial crisis, many companies engaged in extend and pretend transactions. These involved extending the maturity of the company's debt on the hope that the financial conditions would improve, but without any meaningful changes to the company's business. As of earlier this year, extend and pretend transactions were at their highest on record. Though it appears this has not yet resulted in immediate negative effects, will our luck run out in future years? Many of the traditional passive investors in BSLs are not well equipped to handle decisions requiring analysis of the issuer's business prospects. This has led to the rise of the snooze drag, where CSLs strategically do not take action on extension requests, allowing them to take effect by default. This has resulted in investor complaints because the CLOs would otherwise be required to return their investors' money. To me, a situation where many borrowers are seeking to refinance by extending their existing loans without any real changes, and can only do so by convincing their lenders to snooze, is a flashing warning sign. What happens when borrowers' ability to engage in this tactic runs out? Will pro-cyclical forced sales occur? And will regulators and the public be caught by surprise when this begins to affect the real economy? I should note that the two dynamics I've mentioned, investor protection and systemic risk, are interconnected. Markets in which securities protections are not present mean investors have less information, less confidence in the integrity of the information they do have, and fewer assurances that market participants will not abuse the trust investors place in them. Without these rules, the market runs a higher risk of unraveling with potentially systemic consequences for the real economy. Greater disclosure and the greater integrity of disclosure that comes with anti-fraud rules, protections against insider trading, and gatekeepers would guard against the BSL market becoming a proverbial market for lemons. I would also like briefly to touch on several areas that commentators have raised when discussing whether particular instruments described as notes, such as BSLs, should be regulated as securities. Though I believe consideration of these policy issues will not alter the application of the binding Supreme Court precedent in Reeves, I believe they could merit some consideration so that regulators and the industry can work together to develop guidance on areas that may be unclear. In the face of uncertainty about the future development of the BSL market, it could be that regulators have work to do to prepare for a future ruling that certain BSLs are securities for purposes of the Securities Act. First, BSLs are frequently originated by large national banks. I am aware that these banks are generally prohibited from underwriting securities, and that some have argued that if a court were to deem these widely syndicated note securities, it would reduce capital formation. I believe further work is necessary to determine whether or not this is a realistic concern. Are there other arrangements a bank could make, such as conducting the activity through an affiliate? Would doing so require any additional regulatory actions from the SEC or the banking regulators? Second, these assets are already defined as securities for some purposes and not for others. For example, they're already treated as securities under the Investment Company Act. What would prevent a banking regulator from issuing guidance stating that it would not deem widely syndicated loans to be securities for purposes of the Volcker rule, even though the assets would be securities for other purposes? Throughout my remarks today, I've referred to the global financial crisis of 2008. In the years leading up to that crisis, financial institutions had successfully convinced regulators that the laws and the regulations enacted in the wake of the Great Depression could be loosened. They were able to point to decades without a crisis to argue that strict regulations were unnecessary and that the business of banking had become safer. Just over 25 years ago, the hedge fund long-term capital management failed. Until its failure, many believed that hedge funds did not pose a risk to the financial system. This was because investments in these vehicles were privately placed to sophisticated investors who were capable of sustaining large losses. Long-term capital management was run by Wall Street legends, including several Nobel laureates, who were viewed as some of the brightest minds in finance. But despite the apparent safety, the firm melted down over the course of a few weeks and ultimately required a multi-billion-dollar bailout from its counterparties at the strong urging of the Federal Reserve Bank of New York. Its failure is one reminder that the non-occurrence of a crisis does not mean that one could never occur in the future. Regulators must be vigilant about the risks that are around the corner, not just the ones that are in the past. I am aware that some may argue that BSLs have only exhibited isolated problems, and these problems alone are not necessarily evidence of systemic risk. It could be the case that this means BSLs will never cause systemic issues in the financial system. But as in the years leading up to 2008, a metamorphosis in the system may be occurring before our eyes. I worry that this market is becoming riskier in ways that regulators have not yet fully considered. While some loan syndication makes sense to reduce the risk taken by individual banks, I am concerned that we are now in a world where banks lend, but nearly all the risk is transferred to investors who have no relationship with the borrower, and that investors, including retail investors, frequently have a great deal of exposure to these assets. If that is to be the case, regulators across the board must assess whether investors have sufficient protection and whether there are other risks to consider. For example, is the risk of BSLs compounded due to the lack of transparency, price discovery, and regulation of the private offerings through which BSLs are distributed to investors? Consideration of these issues now, before further problems develop, is necessary. Doing so allows us to ensure that a crisis does not threaten the fair, orderly, and efficient markets we strive to maintain. I look forward to working with the public including the people in the room today, to ensure that these outcomes do not occur. Thank you. And with that, I will invite Alex up to the stage.
Thank you so much, Commissioner Krenshaw. It was wonderful to have you here, and thank you for those remarks. They're a great lead into our follow-up discussion to unpack all of this with our two experts here. Each of these experts has an impressive list of accomplishments, and I invite you to look on the website at their bios to see that wonderful list of accomplishments. But I will just quickly reintroduce them. Farthest on my right is Renee Jones, professor and Thomas F. Carney Distinguished Scholar at Boston College Law School. She recently served as director of the Division of Corporation Finance at the SEC. The division staff of over 400 reviews public filings to ensure that investors are provided with the material information that they need to make investment decisions. And they also provide guidance to companies to encourage better compliance and to deter fraud. So she's intimately familiar with the public disclosure framework. George Georgiev is an associate professor at Emory University School of Law. He's a scholar of business law, which overlaps with corporate governance and securities law. And he also brings both a law and economics training to our conversation today. So that will be helpful as we go through this discussion. Importantly, both have worked in private law firms, representing clients on corporate and securities matters, each with a different focus. And as part of their extensive work in securities law, both have written about the growth of unicorns, a type of very large private company that is neither magical nor mythical. It's my privilege to welcome both of you, Renee and George. So let's get started. I thought that we would start out by just kind of building some background and talking about what the public disclosure framework is. And why Congress established it. Have there always been exceptions to those disclosures, or has something changed over recent decades? And Renee, I'll throw that one to you.
Sure. So why do the securities laws exist, I think, is the first question. And I think just to answer that question, I think it's just good to remind everybody the securities laws were adopted in the 1930s, early 1930s, in response to the stock market crash of 1929, which I'm sure we're all familiar with from high school history. But as a reminder, the stock market lost nearly 90% of its value during the great crash, and half of the securities that were issued in the prior decade became worthless. And it was also obviously the beginning of a very difficult period for the formerly thriving middle class because of the banking crisis and, of course, the Great Depression, which lasted for a number of years. So the securities laws were adopted in order to try to prevent those types of disasters from occurring in the future. And then just to think about the philosophy, I think it's important to think about at the time the securities laws were adopted, the architects of those laws opted for a disclosure regime. And that was as opposed to a system of merit regulation. So instead of the government deciding who could offer or sell securities, the securities laws were adopted to ensure that adequate information was provided to investors so that they could make intelligent decisions. And hopefully that would tamp down the kind of market hysteria that contributed to the run-up prior to the crash. So I think of that as sort of the basic bargain that Congress struck with industry. As long as you provide full and fair disclosure to investors, regulators, FTC, SEC, aren't going to get involved in determining which companies should be able to raise money and which companies couldn't. And then these disclosure obligations, I think it's also important to keep in mind that they're backed by very strong liability provisions. So the failure to register, for example, or the provision of false or misleading information to investors exposes those who provided that information to serious consequences. So that's the basic framework. The two statutes that are relevant are the Securities Act of 1933, which basically governs securities transactions. It requires every securities transaction to be registered unless there's an available exemption. And I know we're going to talk a lot about exemptions. The 1934 Act, in contrast, really focuses on making sure investors have information when they're participating in trading markets. And so it basically requires companies that have either sold securities under a registration statement, have securities trading on a stock exchange, or if they're large enough, $10 million in assets, and what was once 500 shareholders, they would be required to register with the SEC, and once registered, on an ongoing basis, provide information to investors through annual and quarterly reports, including, of course, audited financial statements. And that 500 shareholder rule was changed in 2012 to 2,000 shareholders. So now companies that are private companies, startups, can stay private indefinitely and will not have to register, because a 2,000 shareholder limit is very easy to avoid.
So just to review, the companies that are taking advantage of these exceptions are not required to make disclosures that public companies are required to make, such as information about their operations, their financials, their financial statements, which public companies not only have to provide, but those statements are audited by an independent auditor. They don't have to provide information about management and risks and so forth, setting aside any of the newer emerging risks that Emily referred to, that the SEC is now looking at requiring disclosure of, like climate risks. So, okay, so let's talk about the fact that many of the exemptions are based on investors being accredited or somehow more sophisticated, and therefore, for some reason, the idea being that they can afford to lose, or they know what they're doing. Is that possible when there's no disclosure at all? It seems like no matter how sophisticated you are, you need information in order to make an investment decision. But George, could you tell us a little bit more about the accredited investor and sophisticated investor exceptions, and whether those actually work or not?
Sure. I think that the initial logic of these exceptions and exemptions was sound, where you had much smaller private markets, and companies and issuers needed to have the ability to offer securities to small groups of investors who truly were sophisticated, and they allowed companies, these exemptions allowed companies to raise capital in speedy and efficient ways. Unfortunately, the expansion of the exemptions over time has actually resulted in the exemption swallowing the rule, if you will, where you end up with large swaths of the investing public fitting within these exemptions and exceptions. And I know Renee has looked at kind of the underlying dynamics. And so I don't know, Renee, whether you wanted to add anything on that.
Sure. Just to provide a little bit of background information. So every securities transaction has to be registered unless there's an exemption. And of course, Congress created exemptions for in instances where Congress decided registration wasn't necessary. And the most important exemption for companies is the private offering exemption, which basically says if the investors can fend for themselves, meaning they have access to the same type of information that would be provided by registration, then the transaction doesn't have to be registered. So initially, as interpreted by the Supreme Court, that was a pretty small, narrow slice of the potential investing public. Basically, company insiders, people who had close relationships with company insiders, and then that was expanded to investors who were provided information, had the opportunity to ask follow-up questions, and also were sophisticated enough to understand that. So those are pretty open-ended standards. So in 1982, the SEC tried to provide more clarity, and that's where the accredited investor definition came in. So under one provision of Regulation D, I know I'm getting a little bit in the weeds, but the rule is very important, Rule 506. Almost all unregistered transactions occur under Rule 506. If all of the investors are accredited, there's no limit on the amount that can be raised. There are no disclosure requirements at all, and you can sell to an unlimited number of investors. So with that exception, that was sort of the beginning of what George is describing as the rule, the exception swallowing the rule. Accredited investors includes any individual with $1 million net worth, now excluding their principal residence, or $200,000 of income, or $300,000 with their spouse. So in 1982, 83, when the rule was adopted, that was only about 2% of American households. Now it's more than 13% of American households. And those numbers have never been adjusted for inflation. So the 200,000 would be about 600,000 now. If it had been adjusted for inflation, the $1 million net worth would be, I think, like $2.5 million. And so, as without making adjustments for inflation, just that exemption has just continued to grow.
Wow. So it's pretty broad exposure there for the public. And I think you said the original deal was if you sell securities to the public, then you should make public disclosures, under the securities laws. Did you have some more data, George, about just the size, the scale of the problem, how big the private markets are?
Yeah, absolutely. So the term unicorn as applied to private markets and capital markets is fairly new. And it used to be the case back in 2013 that these companies with massive valuations that was still private were really unicorns. They were very rare and they initially didn't exist. Well, today we have 656 unicorns just in the United States and twice as many worldwide. Whereas when the term was coined, in 2013, there were about 40. The implied aggregate valuation of all unicorns today is over $2 trillion. Now, it's interesting to take that number, $2 trillion, and unpack it. So that is $2 trillion of private firm assets that are in investors' portfolios. But how much confidence do we have around the $2 trillion? And that is one of the significant risks of private markets, the valuation risk, the risk of mispricing, underpricing, because we have seen countless examples where private companies do go public. They go public at a valuation that is beneath their previous private valuation. So whatever the private markets were valuing those private companies at was revealed to be inaccurate. We've seen down rounds where private companies are actually raising successive rounds of financing at a lower valuation. At the same time, though, there are structural challenges to conducting down rounds. And so even when companies do need to adjust that valuation, that is not easily adjusted. One of the great things about public markets is that if you hold a portfolio of public market securities at any point in time, you know that this is, when you look at the valuation of that portfolio, that is the collective judgment of a bunch of market participants, rating agencies, investment analysts, proxy advisory firms, retail investors, sophisticated investors, basically jointly determine that this is the value of this public markets security. In the private markets, we don't have that community determining valuations, and so we cannot have the same level of confidence. And yet, those securities are marketed and do end up in the portfolios of regular Main Street investors.
And so we don't really know how the valuation is determined in private markets. Could be anyway, we just have no information. Is that right?
We have some knowledge about the strategies that are used, but we have no confidence that those valuations actually are quote unquote accurate. And of course, even public markets are not perfect, but at least we know that, again, if at the end of the day you look at your statement of public market securities, public companies, you can be just as confident in that number as you can be in the number in your checking account or your money market account. If you're holding private market securities or private companies, you cannot have any confidence in that number. And let me just say that this is a problem that securities law scholars have been talking about for decades. Well, for about a decade. I don't want to say about a decade. And it is a problem that the SEC has acknowledged. And increasingly, international regulators are also focusing on this problem. So just last month, the Financial Conduct Authority in the United Kingdom raised a significant concern with private market valuations. The International Organization of Securities Commissions, IOSCO, also raised concern about just this very issue. How much confidence can we have in these numbers, the valuations attached to these private companies?
And so essentially what happens is you have a private company, they have a certain valuation. A lot of people talk about the great returns in the private markets. But then once they file their registration, which provides all kinds of information, then it turns out that everybody looks at it and all of a sudden they don't think that valuation is good. And okay. So I just want to make sure
Yeah, I mean, just to clarify, so companies that would be announced that they did a financing at a private valuation, let's say $20 billion, and then a year or two later, decide to do a public offering and they try to go public at that $200 billion, I think I said. When they get to the public, they disclose all the information. You get a close look at the company, its profile, its path to profitability, if there is one. And then the collective wisdom of the entire market weighs in, and sometimes the valuation will come in at half of what it had just happened to be 2 years ago. And that's happened recently with a couple of public offerings.
And does that happen once in a while, or is this a pretty common occurrence?
Well, right now, as George mentioned, there are a lot of down roads. So some private companies, when they're going to raise more money, they've run out of money because they're not making profits. They're raising at a significant discount, like 50% of their prior valuation. And then if they want to go public, they're going to face that same downgrade in valuation.
Let's talk a little bit more about the risks of this situation, because I feel like we need to dig into that a little bit more to understand why everyone should really care about this. And I know Commissioner Krenshaw referred to some of those risks, but it was in the context of BSLs, and I thought we should maybe talk a little bit more about that and reiterate those points. For example, we know that pension and retirement plan participants are indirectly exposed to the private markets. So that's one area where the risks lie. But it's also, banks making loans, and it isn't just the bank syndicated loans. It's anytime banks make loans in the private markets, they're making a loan to a company that they don't actually have much information about, right? Are there other risks, not just to investors, but more broadly that we should be thinking about?
Yeah, so we can talk about broader risks and counterparty risks. I think that's very pertinent. I also actually want to expand on the point about markets, right?
Sure.
Because it's not just the investors in the private markets and in private companies. So it is no longer the case that you can say, well, if you stay within the public markets, you're insulated from this problem. So this problem only applies to the private markets because the information environment that is created through these public disclosures of public companies is necessary for the valuation of securities. And the longer private companies stay private, the longer they fail to provide those disclosures. So in many industries, half of the companies now are private companies. Very sizable companies are private companies that do not provide disclosures. And of course, all valuation judgments, all materiality judgments with respect to the significance of any type of information are relative. And if you don't understand the industry, because half of the companies in that industry are not providing any information pursuant to the securities laws, then the numbers attached to the public companies in the public markets are also questionable. And that is a very significant problem that is created by the proliferation of private capital.
Wow. That's pretty important, especially when you see private equity funds buying up whole industries and so forth. That's how in housing and healthcare and so forth. That's definitely concerning. I wanted to also talk about the fact that there are certain specific risks that the SEC is trying to be on top of, like climate-related risks. And so, as I understand it, the SEC climate risk disclosure rule is only applicable to public companies, right? But we're reading that a lot of companies, public companies, are spinning off their operations that are emissions intensive into the private markets. Is that true? And then they won't have to disclose, correct?
Yeah, I mean, I think that's correct. That the proposal as proposed would apply to companies that are registered with the SEC. So that that are reporting companies. Those are the companies that have a public listing on a stock exchange, or they're now over what was the 500, now the 2,000 shareholder limit. So since large companies, unicorns, are staying private longer, they're able, as long as they don't do the public offering, they'll be able to avoid any disclosure requirements of the SEC, including any proposed climate disclosure rules. They'd be just not part of that, subject to those rules.
And that seems like it makes it a lot harder for the government when it's trying to regulators when they're trying to determine what the risk of climate disasters are. We're having an increasing number of billion-dollar climate disasters. Very difficult to assess that climate risk throughout the economy if so much of it is basically in the dark.
There's just a lack of transparency. There's a lot of opacity in the market. So it makes it very difficult for investors generally to assess the risks, all of the risks that are impacting or could potentially impact the market.
Right. So did you have something you wanted to add?
Yeah, I think we can generalize from this. And I think that's a terrific example, this practice of so-called brown spinning, where you're basically taking these dirty assets and you're parking them in a private company that has very little transparency. That is bad for investors, as Renee said. That is bad for systemic risk, as you say. And to generalize, I think this affects the regulatory capacity of the state in the sense that a lot of regulation in terms of market efficiency, in terms of governance, in terms of capital formation, competition takes place through the public markets and through this public company regulatory category that we have, which for a very long time, very reliably captured the firms that we wanted to capture, these large, systemically important companies that employed a lot of people, had a lot of assets, created systemic risks. Well, now when we have so many unicorns and basically there is functionally can be very little difference between a public company and a private company, the public company category no longer captures the firms that regulators may want to capture. And so it's not just environmental regulation, it could be any other type of regulation that is tied to this public company regulatory category.
Got it. And it seems like that's a huge risk. But in addition, when you're looking at these large companies that are in the private markets, it isn't just their investors either. It's the fact that they sell products and services to millions of Americans, and they employ potentially thousands of Americans. And then they have lots of shareholders, but because of this problem, this sort of loophole in the law where they can count, what is it, a holder of record could be an institutional investor. Can you explain that in a little more detail for us so people understand why they don't really only have 2,000 shareholders?
Well, one way to look at it in terms of the private companies generally sell mostly to private investment funds, but George mentions a lot of those private investment funds are actually pension funds, and more of them are mutual funds, which basically are the types of funds that most retirement assets are held in. And so there's a lot of public money already going into these quote unquote private companies. But putting that aside, as companies get larger and they have, well, first of all, they have hundreds or thousands of employees who have shares, but those are excluded from the count. And those employees aren't necessarily getting really good disclosure either. They get some information, but not really enough for them to make informed decisions about whether they want to stay with the company, whether they want to exercise their options, or whether they want to sell their shares in what's developing as these private trading markets. But then furthermore, companies can sell, trying to stay under that 2,000, can sell to partnerships or special purpose vehicles that are formed just for the purpose of holding those shares. And those vehicles can have hundreds, maybe even thousands of beneficial owners, but we're only going to count that one partnership that holds only one company's shares as one shareholder, even though that partnership may have sold securities or sold interest to hundreds of investors. And so there are ways to avoid that 2,000, even though it's a very high threshold, there's ways to engage in kind of creative structuring to evade that threshold and stay private indefinitely.
Okay, great. Thank you. And I realize we didn't cover one thing that I had intended to ask, and I can't remember which of you wanted to talk about this, but just the question of whether having these private markets the way that they are and growing the way that they are, does that impact the public markets beyond what you were saying, George? Does it have an impact on the amount of capital in the public markets? And does that impact whether the private markets actually help small businesses as is often claimed, or does it actually have a detrimental impact on small businesses obtaining capital?
So maybe I can start and pivot to Renee. I think capital allocation and allocative efficiency is a basic function of the capital markets. I think it's often said that the amount of regulation in the public markets discourages businesses from going public. I think we have to remember that there is a lot of tailored regulation and a lot of scaling of regulation. So when smaller companies want to go public and access the public capital markets, they actually end up being subject to just a subset of the suite of regulations that we associate with big companies. So there is a on-ramp in terms of regulation. I think it's also helpful to remember that the public markets, for all of their all the regulatory burdens that they may entail, are attractive to businesses, and companies worldwide continue to come to the United States to access the U.S. capital market. So it is not the case that it is, and it is because of valuation, liquidity, basically the confidence that you can have in getting the price right through the collective work of investment analysts, rating agencies, investors, and others. And so I think in terms of capital formation, this growth in private markets does end up having a distortive effect. I think also what is a problem is the lack of information, right? We have very little information about private markets, and that is something that is an artifact of the small, isolated nature of private markets historically. Well, as private markets have ramped up in size, we haven't kept up, and we haven't even paid enough attention to Form D and kind of other required filings that that companies have to make. But in terms of allocative efficiency and in terms of the overall working of the economy, I think we have to remember that one way that through which the government, the federal government, has solved some of these problems is through the federal securities laws and through the corporate governance requirements that are embedded in them in terms of independent directors, in terms of internal controls and procedures, and so on. And those do not apply to private companies. And that's where you see these corporate governance problems in private companies that Renee has studied and written about extensively. So I'll pivot to her.
Yeah, so just compared to public companies, especially after Sarbanes-Oxley, there were a lot of corporate governance provisions put in place. But even before Sarbanes-Oxley, the structure of the federal securities laws includes important corporate governance provisions, including shareholders' voting rights and things like that. None of that applies to private companies. It's all privately negotiated. So when these private companies are getting very large, what we're seeing happening is that there's so much competition among investors to be able to invest in the fastest growing companies that these investors are giving up their governance rights that they traditionally held very dear, and they're handing over those governance rights to these founders who are generally pretty young, pretty inexperienced, and really haven't kind of proven themselves to be trustworthy. So we've seen a number of major scandals involving some of the largest unicorns, including WeWork, Uber, FTX, and Theranos. And if you look into what happened, in a lot of those instances, we see that the investors, the experts, the sophisticated investors weren't paying attention, or they were paying attention. They were worried about some of the problems, but they felt disabled from intervening because they had given over the governance rights to the founders. That's a whole other set of problems that impacts not just investors, it impacts the public, consumers, employees, and customers as well.
Indeed, all those sophisticated investors that invested in FTX, I guess, didn't care or didn't know that FTX didn't even have a chief financial officer. So it seems pretty basic. Well, I think now we're at a point where we need to start taking some questions from the audience, both online and in person. Are there any questions from here in the room? If not, we can start by taking, oh, we have one? Ah, I see you.
Hi, my name is Tracy Lewis. I'm Senior Policy Counsel and Climate at Public Citizen here in DC. And I have a question for the whole panel. We keep referring to these private investors as unicorns. And the very nature of a unicorn is that it is rare, special. But if there's, I don't know, what do you call a herd of unicorns, but a herd. So now we're seeing a situation that we have so many private investors who do not want to disclose the nature of their entities publicly. What do we call them now? I think this does call for a nomenclature update, and if we change the name, could that help shift some of the thinking around why they deserve these special rights that they have been able to get away with so far?
Thank you for that question. I think you had some nomenclature changes you were going to recommend for those really big companies in a paper you wrote, George.
Well, so I think a group or a herd of unicorns is supposed to be called a blessing. I read. I've never heard one. I've never seen one. So that's. But I think that's what they say. Now, I think your point is very perceptive and it's very right. We may not be referring to them in the right way because they're everywhere, right? So they're no longer unicorns. And also unicorns are supposed to be exotic and, maybe something desirable where, through all these problems that they're causing, WeWork, Uber before it went public, and Theranos, FTX, there isn't anything desirable or endearing about that. Very problematic. And so I'm not sure what term we should refer to them by, but I have talked about in terms of
big companies.
Big companies, but I have talked about kind of the paradox, right? The public company regulatory paradox, where you're regulating public, companies that very much look alike in terms of size, in terms of number of employees, in terms of their systemic impact, and yet the public companies, those that opt into the regime, are regulated pretty significantly, pretty heavily, whereas the unicorns are not, and that is a problem.
I guess what's rare is the regulation.
Yes, yes, exactly.
Yeah, large public companies or mature startups, they're not startups either. We call them startups, at least in the literature. When we're writing as professors, we're like, oh, startups need to be regulated. And they're not startups because some of them are 10, 15, 14 years old. And so, but large private companies, large unregulated companies, I don't know. Find those out.
Yeah. Thanks. Lilith, did you want to read us? We've got Lilith Fellows Grand, our policy analyst over there. She was going to read some questions from our online audience.
What do we know about the climate risk exposure of these shadow banks? Is there evidence that this exposure alone presents systemic risk?
Shadow banks. Debt.
Well, I think it's really interesting with respect to, I think, George covered it. The way we regulate corporations in the US is through public company regulation, and as more and more companies are staying private, that system's going to start to break down. And the climate rule is just one example. If the SEC adopts a rule that requires Scope 3 emissions disclosure, then we will capture at least some of what's going on within the private companies. But if the SEC does not adopt that, but as it proposed, there is going to be less transparency in terms of market risk to the economy. With respect to that part of the economy. But I would mention, of course, in California, the law that was just signed would apply to all large companies, $1 billion of revenues or more, doing business in California, regardless of whether or not they're public companies. So California at least has taken a different approach, and Europe has taken the same approach. So it could be that the SEC rules are becoming less and less relevant as these other parties are moving forward faster.
And the US will become a more risky place to invest, it seems.
Well, the biggest U.S. companies are going to have to disclose under the California rule, regardless of when the SEC acts and what it looks like.
The people will have to go there with their information.
Well, once they disclose, everyone will have the information.
Yep. Yeah. Great. Thank you for that. And I guess I did want to say one other thing, and that is sort of the correlation of the economy, that the connection of debt between just the broader economy and in the private markets. If you have a segment, I think you were referring to this, George, if you have a segment of the debt market, for example, that's dark, that can cause reverberating risks throughout the financial system and the economy. So that's another part of the answer. Do we have time for one more question, or? Yes.
Paul Kiernan with the Wall Street Journal. Caroline Krenshaw has mentioned, the possible remaking of Form D to require more information from private companies. People have also spoken about 12G and trying to look through certain entities to make it easier to hit that 2,000 shareholder threshold. I think both of those items are on the SEC's Reg Flex agenda, but we haven't seen any movement, at least on the outside, that they're getting close. Will you guys be disappointed if they don't adopt something or propose something?
George, you want to take that one?
I think I would be disappointed personally. I think there is good reason that they're on the Reg Flex agenda. I think those are difficult issues and highly technical issues. I think we've left some of those regulations without updating for way too long. And so traditionally, capital markets evolve at a very fast pace through innovation, technology, globalization, other reasons. And so we've, through the decades, updated those regulations. I think now the regulations have really fallen behind. I think, so all I can say is there is good reason that they're on the Reg Flex agenda, and I would like to see the SEC act on them. But I also recognize that those are very difficult and tricky issues.
Great. Thank you, George. Chris, did you have a question? Oh, okay. Okay. Right. Great. Do we have time for one more on? Oh, okay, great. Sure.
Hi, Andrew Ramonis with Bloomberg Law. Professor Jones, you worked on the SEC's climate proposal at the agency. What's the likelihood the SEC will adopt Scope 3 requirements as proposed? If you're a betting person.
I'm not at the SEC anymore, so I don't know the answer to that question.
As an outside observer.
I don't know.
We all wish we knew the answer to that question, Andrew. Okay, any others? Time for one more online or?
We have one more online. Do you think that valuations are delayed and smoothed because limited partners enjoy investing in vehicles that look somewhat uncorrelated to the market?
Yes. Yeah, I mean, I think that is very perceptive. And I think that's one of the reasons why private markets actually may look more attractive than they actually are, because they look insulated from the risks of the market. But of course, we know that they aren't. There's no such thing as a free lunch.
That's a great line to end on. And I want to thank our audience here for coming. Renee and George, thank you so much for making the trip to DC to help us understand. You did a great job, and we're really grateful and wish you a safe trip home. And I want to thank our in-person and our online audiences as well. We hope you'll keep an eye on our website and think about attending another CAP event in the future. Thanks so much, everyone.